Good morning. I want to begin by saying we are living in extraordinary times, not only because the patterns that have governed markets for decades are now bending, but because they may be breaking. My name is Ray Dalio, and today I'm going to show you why there is a big problem emerging with silver right now, what that means for the world, and how you should think about it. When you look at what's happening with silver today, you can't just look at the price. You have to look beneath it at the structure of the system that determines that price. The issue isn't that silver is simply going up or down. The issue is that the forces shaping its value are moving in opposite directions. On one hand, you have silver as an industrial metal used in solar panels, electronics, and technology that's shaping the next generation of energy systems. On the other hand, you have silver as a store of wealth, a hedge against monetary instability. When those two worlds start to pull away from each other, an imbalance forms that doesn't stay hidden for long. What's developing now is a structural imbalance, one rooted in the way demand and supply interact across two very different systems. Industrial demand is long-term, slow-moving, and real. It's tied to projects that require years of investment, infrastructure, and production. Monetary demand, on the other hand, is emotional, cyclical, and reactive. It spikes when trust in paper money weakens and fades when confidence returns. When both sides of that equation grow at once, the structure of the silver market begins to strain. Over the past few years, we've entered an era where technology, energy transition, and monetary instability are converging. Governments are spending heavily, debts are expanding faster than incomes, and central banks are creating liquidity to keep the system functioning. These actions have long-term consequences. They debase currencies, distort prices, and push investors to seek something real. Meanwhile, the world's industrial appetite for silver has grown quietly but powerfully. Each solar panel, each electric vehicle, each data network relies on silver's unique properties. That demand doesn't disappear in a downturn. It's embedded in the physical economy, but the mining and refining system that produces silver is not structured to meet both types of demand at once. Silver is often produced as a byproduct of other metals, meaning its supply doesn't respond quickly to rising prices. It's not like oil, where producers can ramp up output with investment. If the price of silver doubles, it doesn't necessarily bring double the supply. This structural constraint means that when industrial and monetary demand rise together, the market tightens quickly. Prices can move sharply not just because of speculation, but because the underlying system can't deliver enough metal to satisfy both forces. This is what creates instability. Markets at their core are systems of expectations. When those expectations diverge from the physical reality beneath them, corrections happen. The imbalance we're seeing with silver is not just a short-term market phenomenon. It's a reflection of a deeper mismatch in how the world values tangible resources versus financial assets. For decades, we've built an economy that's heavily financialized, where derivatives, paper promises, and digital claims vastly exceed the physical quantities they represent. In silver, that distortion is especially visible. The amount of paper silver traded daily dwarfs the actual metal that exists above ground and is available for delivery. At some point, those paper claims will be tested. When confidence in fiat systems weakens, investors turn toward hard assets. That shift starts slowly, then accelerates. When it does, the difference between what exists on paper and what exists in vaults becomes critical. That's when structural imbalances show their full force. You start to see delivery delays, rising premiums, and sudden volatility as markets attempt to reconcile paper promises with physical scarcity. This is not new. History is full of examples where societies expanded credit and money faster than real productivity. Each time a correction followed, a shift back toward real assets, commodities, and tangible stores of value. Silver has always played a role in those transitions because it bridges the gap between money and industry. It's not purely speculative, it's essential. When the structure of the global economy changes, silver doesn't just reflect that change, it amplifies it. What makes this moment different is scale and speed. Industrial technology has never depended so much on silver, and global monetary systems have never been so leveraged. When you have a resource that sits in the middle of those two systems, small disruptions can ripple widely. A supply shortage or a policy change can trigger reactions across energy, manufacturing, and financial markets simultaneously. The imbalance doesn't have to be large to have an impact. It just has to be structural, baked into how the system operates. And here's where perspective matters. Most people think of silver's price as a reflection of supply and demand. In truth, it's more a reflection of trust. When trust in the financial system is high, silver's monetary demand falls. When trust erodes, that demand returns quickly. The industrial side doesn't care about that psychology. It just needs metal to function. When both forms of demand collide, the system has no easy way to adjust. That's why we can see years of calm followed by sudden violent repricing. The underlying forces are already visible. We see countries diversifying away from the dollar, central banks accumulating gold, and investors questioning whether fiat currencies can hold purchasing power in an era of political and fiscal strain. At the same time, global efforts to decarbonize the economy are accelerating each step, increasing silver consumption. The two trends, monetary uncertainty and industrial expansion, are moving in the same direction, creating the very imbalance that will drive the next big movement in silver. The lesson here isn't to predict an exact price or timeline, it's to understand the nature of cause and effect. When you have a system where financial claims exceed physical reality, where demand outpaces adaptive supply, and where trust in money is weakening, something must adjust. That adjustment is often sudden, painful, and surprising to those who didn't see the structure beneath the surface. So when you think about silver, think beyond the price chart. Think about the system itself, the incentives, the dependencies, the bottlenecks, because that's where the real story is. The imbalance is already here. It's just not fully priced in yet. And history shows that structural imbalances never stay hidden forever. They resolve one way or another, and when they do, those who understood the mechanics beforehand are the ones who benefit, not because they guessed, but because they observed the system as it truly is. There's a powerful dynamic in markets that most people don't pay enough attention to: the leverage of neglect. It's the tendency for things that have been ignored for too long to accumulate potential energy, which when finally recognized releases in a violent and disproportionate way. Silver is one of those things. For years, it's been treated as a side note in financial discussions. It's not flashy enough to capture mainstream attention, not stable enough for institutional investors, and not large enough in market cap to influence central banks. Yet, that very neglect is what creates the leverage for the next big move. When a market or an asset is neglected, its price doesn't reflect its true importance to the system. That's not just a theoretical observation. It's a recurring historical pattern. We've seen it in currencies, commodities, and entire countries. The cycle starts when something falls out of favor because it doesn't seem urgent or relevant. Attention moves elsewhere. Liquidity dries up, capital leaves, and narratives fade. But the fundamentals, what actually make that thing valuable, continue to evolve quietly in the background. Over time, the gap between perception and reality widens until something triggers recognition. Then all at once, the market rushes to correct it. Silver today is sitting in that quiet stage. Its role hasn't diminished, but attention has. The majority of capital flows to financial assets that produce yield stocks, bonds, and digital platforms, while silver, a non-yielding tangible asset, has been largely sidelined. The irony is that the very conditions that cause investors to ignore silver, stable markets, low inflation, confidence in fiat systems, are the same conditions that sow the seeds for future instability. As confidence in paper assets grows excessively, the value of hard assets like silver gets compressed. When that confidence breaks, the compression releases and silver's price doesn't just rise, it rebalances toward reality. Neglect creates asymmetry. It means the downside has already been exhausted while the upside remains unpriced. Investors often misunderstand that risk is not just about volatility, it's about exposure to what isn't being considered. Silver's market is thin, its sentiment weak, and its coverage minimal. Those are all signs of neglect, but they also mean that when perception changes even slightly, the impact will be magnified. A small inflow of capital into a neglected market can move prices significantly because the structure wasn't built to handle attention. That's the leverage and neglect. There's also a psychological aspect. Human behavior in markets tends to move in herds. Attention clusters around what's popular. When that happens, valuation extremes form. Some assets become overt, owned, overleveraged. Others become underowned and forgotten. History shows that the most dramatic opportunities emerge from the forgotten side. When no one wants to hold something, its price reflects not its reality, but the crowd's disinterest. Silver fits that description perfectly. The crowd has moved to tech stocks, crypto, and new asset classes, leaving silver in the background, but the fundamentals, the supply constraints, the industrial demand, the monetary dynamics are quietly tightening the noose. You can see this pattern if you look back. Before major turning points, silver was almost always neglected. In the late 1960s, few cared about it until monetary instability made it relevant again. In the early 2000s, it was a forgotten metal trading under $5 an ounce until the monetary and credit cycle turned and it soared tenfold. Each time the setup was the same, long periods of quiet neglect followed by sudden recognition. The neglect built leverage and the leverage exploded when conditions shifted. What's happening now feels similar. The world is flooded with liquidity, governments are running record debts, and currencies are being stretched to sustain political and economic promises. In such an environment, assets that are real and finite like silver become increasingly important. Yet, because silver doesn't have the marketing machine that other assets do, it remains under the radar. The longer that continues, the more powerful the eventual rep pricing becomes. This isn't just about price appreciation, it's about systemic correction. Markets are always seeking equilibrium, even if they overshoot in the process. When attention is concentrated in overvalued areas, the neglected ones are left with suppressed valuations and pent-up energy. When that pendulum swings back, it doesn't stop at fair value, it overshoots in the opposite direction. Silver, by virtue of being neglected, has stored that potential. Its leverage is not in derivatives or financial engineering. It's in human behavior, in the emotional reallocation of attention that occurs when trust in other assets starts to crack. Neglect also affects policy and production. Because silver has been out of the spotlight, investment in new mines has been limited, exploration budgets have fallen, and refining capacity hasn't kept pace with industrial demand. That means when demand does rise, the supply side can't respond quickly. The market structure amplifies small shifts into large movements. That's the mechanical side of the leverage of neglect. It's not just about investors waking up. It's about the system's inability to scale fast enough when they do. The critical insight here is that neglect itself is a form of leverage. When people ignore something, they assume stability. They think it hasn't moved much, so it probably won't. That assumption builds complacency, but systems under neglect are often more fragile than they appear because there's no buffer, no preparation, and no expectation of change. When the narrative finally shifts, the reaction is always outsized because nobody was positioned for it. Silver is sitting in that kind of setup. Think about it this way: if everyone owns an asset, there's no one left to buy it. If no one owns it, the smallest spark can ignite demand. The silver market is in that latter position. It doesn't need a massive global event to rise. It just needs awareness to return. A change in interest rates, a geopolitical shock, or a currency crisis could be enough. When those things happen, attention floods back and the market adjusts rapidly to years of underpricing. The lesson is simple but powerful. What's ignored today can define tomorrow. Neglect is not absence, it's accumulation. It builds quietly until it can't anymore. Then the adjustment comes, and it feels sudden to those who weren't watching. Silver's neglect has lasted long enough that the leverage is real. The imbalance between perception and reality has stretched far enough that the next reversion could be significant. That's how markets work. They punish complacency and reward awareness. Those who study the neglected corners of the system, who pay attention to what others dismiss, often find themselves prepared when the cycle turns. Silver right now is that neglected corner. And when the leverage of neglect finally unwinds, it won't just be a story about a metal. It will be a lesson in how attention itself creates and destroys value. Every economic era eventually reaches a point where the old system starts to strain under its own weight. You can see it in the numbers, debt levels, deficits, monetary expansion, but you can also feel it in the tone of markets, in the way confidence starts to erode quietly before it breaks openly. That's the environment we're in now. The system is creaking, currencies are being stretched, political promises are exceeding economic capacity, and the gap between financial assets and real-world productivity is widening. This is what I refer to as a period of macro-systemic risk. A time when the very structure of the economic machine is unstable, and when that happens, hard assets start to behave differently. In normal times, people don't think much about systemic risk. They trust that the system will hold, that central banks will manage inflation, and that governments will honor their debts. But systems like ours, built on leverage, confidence, and liquidity, don't fail all at once. They decay slowly through the erosion of trust. You see it in the small signs: first, deficits that don't close, currencies that weaken a little faster than expected, central banks that move from temporary stimulus to permanent dependence. These are not isolated problems. They're symptoms of a deeper structural imbalance that builds over years. When you print too much money relative to what an economy produces, you debase the currency. When debt grows faster than income, you borrow from the future. Both dynamics are sustainable only until they're not. Eventually, reality reasserts itself, and the system has to adjust. That adjustment usually takes the form of a shift from paper wealth to real wealth, from financial claims to tangible assets. That's the essence of the hard asset response. When people lose confidence in the promises of the financial system, they seek what can't be printed, diluted, or defaulted on. Silver and gold have always served that role. They are the physical mirrors of trust, or rather of distrust. When paper systems weaken, hard assets rise, not because they change, but because the world around them does. The same ounce of silver that seemed unnecessary when credit was easy suddenly becomes a store of certainty when credit tightens. The value doesn't come from speculation, it comes from the recognition that something real has become scarce relative to everything imaginary. We're in one of those transitions now. The global monetary system is overloaded. Debt to GDP ratios in major economies are at levels that historically led to restructuring or devaluation. Central banks are caught between two impossible choices: tighten policy to fight inflation and risk collapsing debt markets, or keep easing to sustain growth and risk currency debasement. Either path leads to instability. In such an environment, investors start to reassess what safe means. Government bonds, once considered risk-free, now carry inflation risk. Cash, once stable, now loses purchasing power daily. The traditional hierarchy of safety is being inverted, and that's where hard assets step in. Silver's role in this is unique because it operates on two fronts. It's not just a monetary hedge, it's also an industrial necessity. As systemic risk rises, the demand for physical resources increases, not just from investors, but from the functioning economy itself. Energy transition, electrification, and digital infrastructure all require silver. That means even as financial stress grows, industrial use doesn't disappear. In fact, it may expand as governments push investment into infrastructure and green technology as a way to stimulate growth. The result is a rare alignment, a monetary hedge that's also a productive input. That combination makes silver particularly responsive in periods of macro stress. Another part of this dynamic is behavioral. When systems are stable, people think linearly. They believe tomorrow will look like today, so they take on more leverage and more risk. But when instability grows, behavior changes quickly. Investors, institutions, even nations begin to delever, not necessarily by paying down debt, but by moving from claims to ownership. That's why during times of systemic risk, you see central banks accumulating gold, sovereign wealth funds buying resources, and individuals turning toward tangible stores of value. It's a natural, almost instinctive response to uncertainty. What's important to understand is that this shift isn't emotional, it's cyclical. Every major monetary regime in history has gone through it. The Roman denarius, the British pound, the US dollar all experienced periods where the expansion of debt and money creation outpaced real productivity, leading to a phase where hard assets regain dominance. It's not a question of if, but when. The pattern is as old as civilization. Financial promises expand until they exceed what reality can support, and then the adjustment comes through currency debasement or repricing of real goods. We're seeing early signs of that now. Inflation may ebb and flow, but its underlying causes, monetary expansion, fiscal deficits, geopolitical fragmentation, are structural. Supply chains are regionalizing. Trade blocs are fracturing, and global coordination is weakening. That all adds to systemic risk, and when trust in global cooperation declines, nations start prioritizing self-sufficiency in energy, food, and resources. Those are all physical realities. You can't print them into existence. That's why in times like these, tangible assets outperform financial abstractions. For silver, this creates a perfect storm. It's being pulled by both sides of the macro equation. As money loses credibility, it gains appeal as a hedge. As the world rebuilds its industrial base, it gains appeal as a resource. That dual demand is what transforms silver from a forgotten metal into a strategic one. Investors who only look at charts miss that deeper shift. The move into hard assets isn't about speculation. It's about adaptation. It's the system trying to rebalance itself after years of excess. The hard asset response is the market's immune system kicking in. When confidence breaks, the body of the economy seeks something solid to anchor itself. That's not panic, it's survival. Those who understand this process don't chase short-term moves, they position for structural change. They diversify, they hold real assets, they think in terms of resilience, not return, because in a world where everything is interconnected and over-leveraged, resilience becomes the ultimate form of wealth. So as macro-systemic risks rise, the reaction we'll see won't be random. It will be predictable. Currencies will lose purchasing power, debt will be devalued in real terms, and hard assets will reprick accordingly. The system will reset as it always has. And in that process, silver will once again remind people that real value isn't printed on paper. It's forged in scarcity, utility, and trust. The cycle is repeating. And those who understand the nature of it don't fight it, they adapt to it. They recognize that when the financial world becomes unstable, the real world becomes the anchor, and that anchor more often than not is made of metal. In closing, let me leave you with this. History doesn't repeat, but it rhymes, and when I look at silver, its dual role, the structural demand behind it, the supply constraints, and the monetary stress in the system, I see a rhyme forming. And I see the problem emerging, a mismatch between expectation and reality, a latent pressure that has yet to be fully acknowledged. What you do with that insight is up to you, but ignoring it is a decision too, because when the adjustment comes, you don't want to be surprised. You want to be ready. Thank you for listening. Stay curious, stay humble, and prepare for